All right, well, those are the headlines that we will be tracking for you all day today on ET Now. But let's kickstart the Money Show then and introduce our very first guest on this show. We have with us Santosh Joseph. He's the founder and managing partner with Germinate Investor Services. Santosh, hi. A very good evening and thank you so much for joining us today on the Money Show on ET Now. Santosh, to start with, while we often say that it's important for individuals to put their money to work, this by investing across a series of investment instruments that are available, be it equity, debt, so on and so forth. Many a times investors fail to do that. Usually fixed deposits and gold are the first port of call. They sometimes fail to invest in equities. Sometimes even if they do, they sort of invest a bit more than they should. Equities are in generally riskier and they're taking on board more risk than they can. We saw that even during the lockdown when everybody started to trade in equities, using these amazing fintech apps. So to start with, what sort of asset allocation strategy would you recommend investors follow? Or if you could just give a guidance, because I understand that for different age cohorts, for different income category brackets of people, it'll be different. So if you could guide them through how to invest their money where, what should they keep in mind?
People have different asset allocation patterns based on their age and their specific needs. But some guidelines that one could follow is that first measure yourself up in terms of risk, time, and what is the outcome that you need. Now, when you start measuring yourself with what is the timeline that you have and also what is the risk that you can digest. You said a point that a lot of people gets invested only in bank savings and FDs, and even they move into equities, they move a lot more. This happens usually because one, you do not have a clarity of what time frame you have, or maybe you don't have a clarity of what is the risk you can take. Therefore, having an asset allocation pattern is a outcome of measuring your risk and the time horizon that you have. Once you get these two in place, that, hey, what is my outcome required? The risk I can sort of tolerate or digest, and then what is the time horizon I have? I add all these 2-3 variables up, I arrive at a risk asset allocation. Assuming, let's say, someone like me goes in for a 50% equity and 50% debt. Then I stick to it and over time figure out how I can be disciplined about it. If markets are going haywire, do I need to reallocate? Do I need to rebalance? This is a constant process that one could stick to.
Okay. Is there a simple rule that one can follow on how much of their income or how much of their investable corpus they should put in equities, how much should they put in debt? Or even if we say debt, I talk about the fixed income umbrella. So I would like to put fixed deposit and all of these fixed income instruments in that umbrella. So what sort of a rule would you recommend individuals follow?
A very, very generic thumb rule called, 100 minus your age and the remaining portion to be in equity. So, for example, if equity and debt is usually they use the age minus 100 as a number to get this. So, therefore, if I was let's say a 35-year-old person, 35% of my money would be in equity, and the balance portion of the 35% of my money would be in debt, and 65% of my money would be in equity. Now, this is a very, very generic thumb rule, but it helps as a starter to figure out that age and your income generation ability is a good indicator to figure out how much money should get into equity, because equity tends to be risky, but also over a long period of time, this is an asset that tends to beat many other assets and gives you a real return compared to even fixed income. So within fixed income, the reason you look at fixed income is not only returns, but also for safety, for stability, and to meet your maybe immediate needs, intermittent needs, emergency needs, and liquid needs. So therefore, your portfolio debt or fixed income is actually broken up into two. One is an investment portfolio. One is just a savings or a liquid or contingency portfolio. So that could be in really short-term, good quality debt. The balance portion, which you want to look at maybe for 3 to 5 years or maybe more than that, you break it up into medium to long-term debt and then the rest of it into equity. So essentially within debt, you break it up into short-term and long-term, and then in equity over what you want.
The other point, I wanted to discuss with you, Santosh, is investing in equities. It can be very tricky, now is the time when, and with this amazing euphoria that we're witnessing in the equity markets, almost everybody is talking about the markets, and many who are out of it now are also looking to enter in the equity markets, be it via mutual funds or however it is. So there's a lot of exuberance. But then again, there's a point to remember that, okay, if it's so high, then you'll be buying at a higher price. So what I want to get from you is timing of equities, especially by retail investors who, not necessarily have the financial savviness or the know-how to get into the nitty-gritties of equity markets, timing the equities. So for long-term investors, do these things really, matter? Or do you think they should just start now? Do you believe they should just follow the simple philosophy of now is the best time to start?
That's a very good question. I get asked quite often these days, at market being at an all-time high. And mind you, all-time high almost every day in the last few weeks. You see that every day the markets open, markets are making an all-time high. So the guys who missed out the last 6-9 months are having this fear of missing out. And the guys who want to participate are asking this question that how do I make money if I enter at such high levels? The easiest way to answer this question is, please remember, this high that you see is not the end. Even though the market may go higher from here or have a correction from here, this is just a phase or a point in time as far as the life cycle of the markets are continuing, or markets will continue to grow as economic patterns and the demographics and even the dynamics of the economies change. Markets will continue to grow. And we've seen deep corrections and we've seen massive rallies in the past. You take the correction that began from 2000 on the tech bubble, you take the correction that happened in 2008 on the global financial crisis, or maybe the massive rally that you had between 2004 to 2007. There are massive rallies, there are massive corrections, but markets keep moving along. So if you are an investor, one, stick to asset allocation and be disciplined and staggered about that approach. The markets, as we see right now at an all-time high, is not, this is not the end. Markets will go higher from here. And if you think that the markets are going to go only way high, there will be a breather, there will be a pause. So you need to be clear that you have to stay in the market, come at a time not to feel that, if this is a bottom or this is the high, I will not invest at these levels. Don't worry about those things. If suppose you get those things like a bottom or a high to sell and a bottom to buy, you're lucky. Consider yourself lucky. Otherwise, just take a call, keep your time horizon in mind, and also keep the ability of being disciplined while you enter also in mind. It helps.
Okay, that's very interesting. Another point is, and what I'm going to do is I'm going to talk about precious metals as a pack, gold and silver. Just earlier today, we had Mr. Jim Rogers, noted commodity guru, saying that things are going to fall apart. And at that time, it's gold and silver that's really going to help cushion any kind of a blow that, equities are going to deliver. So my question to you is, Santosh, India as a country, as, an investment cohort loves gold. We buy gold, not just in jewelry form, but now the latest World Gold Council report spoke about how gold as an investment as well has been gaining a lot of traction. ETFs, sovereign gold bond schemes, and what have you. How do you recommend individuals go about managing gold as an investment? And also, and this is, I'm sure, a question again that maybe in the minds of a lot of our viewers, a lot of our gold is also in the form of jewelry that, especially the female members in the family do own. And sometimes that could be very high amount. So how do you essentially look at the amount of gold held by a household in either their portfolio or in their household or bank lockers?
I haven't thought to ponder that gold has done very well in the past year, and many investors are very happy with the way gold is made, because the perceived happiness of owning gold and the return that you make, especially in a year like 2020, has made gold a favorite right now. Now, the point about gold is, I think gold or silver or precious metals in particular are going to benefit from this huge surge of global liquidity, which are finding itself spots in various various asset markets, and therefore gold and silver also being a good asset is finding a lot of momentum of those global flows coming in. Now, coming to the investors, a lot of us, especially Indian investors, consumers, think that when we buy jewelry, we're investing in gold. It's partly true and partly not, because when you buy jewelry, you're actually buying gold with a slightly higher cost because it comes in the form of jewelry. There are design, there are making, there are wastage and other charges. And sometimes you're a little disappointed because those costs eat into the value of your investment. When you buy gold in terms of an ETF or in terms of bullion and in other formats as a commodity, yes, you're trying to get the benefit of the upside in gold. Now, we've seen over the last year that the ability to buy gold, whether it's a sovereign gold bond or a gold ETF or a gold savings fund or maybe in some other form of gold, has gained popularity, and I think this will continue. Now, from a investor looking for an advice perspective, I think you should be looking at gold as a diversifying tool. Now, you've seen over the past many years and maybe even decades of experience that gold is usually a very good hedge against inflation, also a very good investment in uncertain times. And in the month of March 2020, you saw such an anomalous market globally where between March and April, oil was crashing and markets were crashing, but that was a point of time gold got a huge tailwind and saw a smart 10-15% gain in just a matter of maybe 6 to 8 weeks. So in uncertain times, in situations where people, they have a flight for safety, gold becomes an attractive investment, and therefore from a portfolio standpoint, it's good to add gold because it diversifies your risk and gives you an element of another asset class in the portfolio.
What about your view on alternative investments? When I say alternative investments, while these may not exactly be classified as AIFs, but for retail investors, these are instruments that they're not exactly familiar with. So take a look at gilt funds. I think for the last 2-3 years, they've been giving double-digit returns to investors. Many investors who are not very familiar with them may have missed out on this. Credit risk funds, well, these have been a little troublesome for investors. And finally, how can I miss out on bitcoins, right? Almost everyone seems to be talking about bitcoins because of the because it has made it's already, millionaire investors now close to billionaires, right? So what do you think about these alternative investment class assets that retail investors especially don't know much about? Do you think they should venture forth, to invest maybe a small amount, or do you think it's best avoided and one should not invest in assets that they don't know about?
First things first, I think we should try and contain the FOMO effect, which is the fear of missing out. Now, when you spoke about gilts, or when you spoke about alternate assets, or maybe even when you speak about Bitcoin, one thing that even comes up in our normal conversation is, hey, did I miss that out? Did I miss seeing the huge upside in gilts over the last 2 to 3 years? Did I miss the entire opportunity to buy Bitcoin at maybe sub $5,000 or sub $10,000 and today being at over $34,000? Did I miss that? Or did I miss investing in some exotic product like a AIF or a PMS or maybe a hedge fund? Now, let me just take it point to point. First, gilts. Now, gilts presented a great opportunity because you saw that interest rates dramatically softened, and it got accelerated thanks to COVID and the central bankers globally and in India trying to keep rates soft. And so therefore these gilts gave a smart return. Now, even now, gilts are actually safe and extremely liquid fixed income instruments, but you have to be very careful about the time that you enter with gilts. So if you have a time horizon and if you want great quality investment with sort of a stability when you have for the holding period, gilts even now make sense compared to the overall fixed income basket that you have. Gilts are a good opportunity, but not for medium to short term or a speculative or to look at what happened over the last 3 years, but going forward as a good chunk of your portfolio. Coming to alternates like a PMS or even a long short or a hedge fund. Now these are for investors who want to maybe explore more options than what they've been used to. So what are portfolio management services? This is giving you access to equity in a little more focused and a little more intense manner. So there is maybe a smaller group of stocks or a set of stocks which is managed by a portfolio manager, where they aim to maybe take a little more larger bets in terms of individual stocks, or maybe take a larger risk compared to a typical diversified equity fund. Then comes the AIFs, either on long only equity or long and short funds. These all aim for maybe absolute return of trying to make the most of the market when it's either going up or going down. Now for investors, if your risk appetite permits, if the ticket size, because a PMS has got a ticket size of 50 lakhs, an alternate investment fund typically begins like an AIF at 1 crore and above, you should figure out whether the ticket sizes and your overall portfolio size matches with this investment outlay, and the risk is in line with what portfolio you have. So we have to go back to asset allocation and risk profile to figure out whether this is the right investment for me, because they may be doing well, but you have to figure out from a portfolio investment size and risk whether it matches up to you. Now, let me come back to the last part, Bitcoin. I think everybody is talking about it today, and thanks to the way Bitcoin has run up over the last few months specifically, it's got everybody's attention, and there is even more pronounced fear of missing out in a story like Bitcoin. Now, I don't want to still call it an investment, because by normal standards you don't call it an asset or an investment. This is a form of an alternate currency which is gaining momentum, and particularly among the millennials. And the phenomena of global liquidity is also getting attracted to assets or alternate investments like Bitcoin, because when people want to try something new, or when people want to take a fresh call on these things become attractive. Now, whether we take large investments or small investment bets in it, it's clearly, I think, a part of our risk and our tolerance. Now, why are these things running up so much? Is because many investors want to take small bets, and the large number of investors with small bets is what is driving the further momentum and liquidity in these, whether it's Bitcoin or whether it's alternate investments or even equity, direct buying or trading accounts being at an all-time high, because everybody wants to experiment today. Everybody wants to, go in and say, what, I have a certain small corpus. I'm willing to, wager or willing to experiment with this money. So there is a new phenomena right now where people are willing to, step outside the comfort zone of traditional investments and try new investments, try a little bit on the riskier side. And, we have to watch and wait to see how all these unfold. But for somebody starting out, there are plenty of opportunities within the diversified equity and good quality equities to invest and make money.
Well, very well explained, Santosh, and thank you so much, for just making the entire topic so easy for all of our viewers, to understand well enough. Well, it's time to get some questions and queries as well answered that our viewers have sent in for you, Santosh. So I'm going to take on board our very first question. It's coming in from Mahindra Govindan. He says, I'm a senior citizen, 66 years old, with no pension invested in fixed income for nearly 50 lakh rupees. Now, I think he means to say that he's invested his pension in fixed income, and that's accumulated to close to 50 lakh rupees. He's saying, now I want to invest in mutual funds, and he wants your advice. So, Santosh, he's already 66. Would you recommend he, put some of his money in equity MFs?
See, with this kind of age profile and considering that he's got no pension, I think the first port of call would be to consider debt funds as much as possible. Now, we know that even debt funds, the YTMs or the yields are slightly on the lower side than what it was a year or two ago. What we do is we figure out his actual needs and the requirement of his capital to generate an income. Now, that is a very important aspect as far as Mr. Govindan is concerned, whether there is a need for growth or there's a need for a certain income for him. Now, if there is a need for income, or maybe he's got a slightly higher expectation of growth, then we'll maybe include a small portion in equity. Now, the equity could be done in multiple ways depending on his, appetite again and the time horizon he's got. You could begin with a fund like an equity savings fund, but traditionally the equity allocation doesn't go beyond 35-40% at a net level. And if he's willing to maybe have a little more equity in it, you can look at some of the dynamic funds which are very well managed. I think over the last 1 year you've seen many dynamic equity funds do really well, but I think that has to be done in a combination. Still, I would say as a ballpark, 65-70% of his money should be in debt. That 25 to 35% should maybe be in equity. There again in equity savings or dynamically managed funds where net you may get about 10 to 20% equity exposure, but still you get the best of both worlds.
All right. Okay. So that's the view coming in for Mahindra. Let's move on and take on board another question from Aman Chopra. He wants to get his portfolio checked. He says that he has a time horizon of 10 to 15 years. His SIPs have been going on for the last 6 months. He and his wife both are working, so they have their EPFs and PPFs of roughly about 30 lakh rupees, and they also have FDs of 30 lakh rupees. Now he's got, I think 8 mutual funds: Axis Multi-Cap, Invesco Small Cap, SBI Focused, DSP Equity Opportunities, Murray Focused. There's a Tata Large and Mid Cap. There are 2 thematic funds as well: Edelweiss Tech, US Tech, and Murray Healthcare. Both of these, of course, have been the flavor of 2020, given this entire defensives strategy. I don't know if he's bought it when they were high, or this is something that he's always had. He also says that they have deployed a lump sum of 5 lakh rupees through STP mode in the above funds. So there's an STP of 10,000 rupees, 1.25 lakh in Invesco Liquid, 1.25 in Tata Liquid, then Murray Cash Management Liquid and Murray Liquid Cash. So all of these are for 10 weeks and 1.25 lakhs. He also wants you to recommend some funds for emergency purposes, and he's got some money of 5 lakh rupees that he can further deploy. So lots going on with him. Firstly, 8 funds, 2 thematic. What's your view on that? And yeah, overall, what do you what are your key takeaways from any changes that he can make in his fund, Santosh?
It's great that Aman has started investing in his SIPs the last 6 months along with his wife. It's good to know that he's also got some diversification in having some money in PPF and in an FD. Now, when I look at the mutual fund portfolio where he's got 8 SIPs going and with 2 thematics, my initial comments would be it's too early to do a portfolio check or maybe even a review. I think you need to let it continue for at least a good 2 years plus, because you've got a long list of mutual funds, which is good. What will happen is maybe after a 2 to 3 year period, you will maybe gradually consolidate maybe from 8 funds to, you'll narrow it to maybe 6 or 5 funds. Now, the flavor of 2020 has been both healthcare and technology, both of them, being chart busters. But the beauty is Mr. Aman has started this through an through an SIP. And I think if he continues this SIP well for the next 3 to 5 years or more, he'll start to see, it even out. And even though if he's bought at a high point, I think he'll see this even out. So it's good that he started the SIP. My recommendation is he continues to keep investing and SIP. Now, even the recent 5 lakhs deployed through STP, I think, is a very prudent decision to spread it over 10 weeks. And lastly, even the additional 5 lakhs he's got, considering where we are at the markets, considering that you have a lot more to consider today because of the market being at an all-time high, to be a little more cautious, I suggest that redo the entire STP bit even for the 5 lakhs and top up with the existing schemes that you have rather than pick up new schemes, because you already got an 8 scheme portfolio and with that 2 thematic ideas. Top up these through an STP, maybe more towards diversified diversified equity funds that you have, and keep the SIPs going. Finish your STP that you've started. Keep the 5 lakhs again in a liquid stroke debt fund to be converted into equity over a next 10 to 12 weeks.
All right. Okay, and I think we have time to take one more question. It's coming in from Azgi Sheikh. He says, I have about 4 funds across Kotak, Axis, SBI and Franklin. It's a mix of multi-cap, large caps and mid-caps. Now my advisor is asking me to exit the Franklin small cap fund. Shall I do that, especially when small caps have not rallied so much? What's your view? I mean, we know we had that whole Franklin fiasco, but that was on the debt side. Do you think there could be any, spillover effect in terms of the management on the equity side? What's your perception?
Well, I don't think you need to worry about Franklin's small cap fund because that fund is in line with the category, which is the micro cap or a small cap space. And the spillover risk from their debt, I don't think is founded or true as far as that investment concerned. Now, as we see markets at an all-time high every day, and I know some of us may not be too happy with the way some small cap funds or mid cap funds have done, though the last 2-3 months even they have rallied really smartly. But on a 2-3 year basis, they're still not a very encouraging return to hold them. But I think this is the time one should really stick in and dig in your heels because fortunately since you got a good combination of large cap, multi cap, and mid cap, and Franklin being the small cap fund, I think they are a good portfolio for a small cap category. And I think there's a good mix of mid and large and small. So therefore Franklin has got a great track record of doing well. This fund has actually got a good track record and also got a legacy of performance and having a good portfolio. I think rather than just exit now after what we've seen in terms of a recovery in the last 6-9 months, it may not be the best option. I would maybe on the contrary recommend you stay invested maybe another 1 or 2 years to see the best of the small cap performance.
Okay, well, that's of course, a general view coming in, not just on Franklin, but also on, in general, mid caps and small caps. Yes, they may not have done as well as large caps, but, when we do invest in mid caps and small caps, you have to sort of just adopt a lot of patience. Okay, on that note, we're out of time. So Santosh, thank you so much for joining us today, on ET Now, helping our viewers as well out with their questions and queries, Santosh. And of course, if you would like your questions to be answered, you can email us. Our email address is themoneyshow@etnow.tv. So write into us any questions you may be having about, your mutual fund portfolio, how to invest your money, where to invest it, how to manage your money in general. Write in on themoneyshow@etnow.tv and we will get it addressed every day on The Money Show. For now, a very quick break. Be right back.